Hello friends, in this video we are going to see when should we refinance a mortgage. Okay guys, the answer is you'll see a great many opinions and rules of thumb for refinancing. Some say you shouldn't do it unless you can drop your rate by at least 2%. Some say you should never pay closing costs, always do a no cost refinance. Some claims that you shouldn't refinance because it will reset the schedule on your loan back to 30 years, costing you more money. There are loan officers who will tell you how much you will save each month by refinancing with them. Like most rules of thumb and sales pitches, none of this is necessarily correct or applicable. So, how do you decide whether it is time to refinance? How do you avoid having it cost you more money? See, to answer that question, you need to consider a few pieces of information. Your current loan balance, your current rate, the rate you think you can get in the market. You can get a good idea of the prevailing rates by going to the Consumer Financial Protection Bureau's Explore Interest Rates page. You will enter your estimated credit score, location, and loan amount to get a range of rates. Don't consider any of those rates to be a rate quote. You will only get that from a lender familiar with the unique situation, but the information will be good enough for your purpose at this stage. I have already talked about the shortcomings of the CFPBS method elsewhere, but if you consider the rate offered by the largest number of lenders in your area, you will be able to make your analysis easily. The closing costs for a new loan. Be aware that there are two categories of closing costs: non-recurring closing costs and prorations, prorations and prepaids. The first category represent the actual costs involved in doing a refinance. It includes title and escrow fees, appraisal, notary, recording, and lender fees for underwriting and document preparation. The second category includes prorated interest on your old and new loans deposits to your new impound account, assuming you opt for one, and possibly an installment of property taxes depending on when in the tax year you plan to close escrow. This second category of closing costs represents things you would be paying on way or another. Even if you were not refinancing, you can get an itemized list of closing costs from your lender. You can pause the video and you can read the document again and again if you are not able to understand the whole thing. To do your analysis, subtract the market rate you determine from the rate you have. I'll assume for this example that you represent mortgage as a rate of 5.625% and you can get a new loan at 4.875%. That's a difference of 0.75%. Multiply that percentage difference by your current loan balance. I'll assume that you owe $350,000. Multiplying that by the interest rate difference give you $2,625. You have to multiply this rate with 0.75%. That is the amount of interest you can save each year by refinancing into a lower rate. Now divide the non-recurring closing cost by the annual interest saving. I'll assume that the cost amount to around $4,000. For this example, you should get 1.52. This means that you would recover the cost of doing the loan in over 18 months. You guys, whenever you face some problem, you can go back and watch the previous page again and again so that you can understand the whole calculation. There will be some who will point out that this method is inaccurate because the amount of interest paid will be less each year. They'd be right, but this will give you enough information to decide whether to move forward or not. I recommend also financing the closing cost into the loan rather than paying them out of pocket. I say this because as low as rates are today, still it is better to preserve cash to invest in ways that will generate a higher rate of return than that of the mortgage. The attentive reader may notice that I have said nothing about the payment. What's the point? After all, the refinancing if you don't save money. The answer is that looking at the payment alone is misleading. Part of the reason your payment goes down when you refinance into a lower rate is because of remortgagation. This means that you may stretch out of the term of your loan to 30 years when you have a shorter time than that remaining. To show how this works, let's consider that you have had 3,50,000 loan with its 5.625% rate for 5 years. Assuming you started with a 30-year term, your payment is $2,175. If you were to reset the term back to 30 years without changing the rate, and there's no reason to do so, your payment would be 2000 and $2,104, a drop of around 160 per month. Hey, are you saving any money? I don't think so. There are some strategies you can use to get the maximum benefit out of a refinance. One painless way is to continue making the same monthly payment you have been accustomed to making. Regardless of what your monthly statement says, the payment is, you don't have to ask the lender permission to do this. Doing this will shorten the term of your loan compared to what you started with. Let's say you add the $4,000 closing cost to 3,50,000 loan. You are borrowing $3,54,000, but the rate is 4.875%. Doing this will shorten the time to pay off your home loan to 22 years, 3 months, nearly 3 years shorter. If paying off your home as soon as possible is a goal, consider a new loan with a shorter term. A 15-year loan will have a rate typically 0.5% lower than an equivalent 30-year one. So if you dropped your 5.625% rate to 4.375% with 15-year loan, you'd have a monthly payment of $2,685. Yes, the payment is $500 higher than before, but you would be saving 10 years of the term of your loan depending on your personal budget. You might consider that a good trade-off. I should mention no cost refinances before leaving this topic. There are lenders advertising these kinds of loans, no cost, no fees, but you should know that any lender can do these kinds of loans. First, know that there is no such thing as a loan with no fees or costs. There are always third party fees, title, escrow, appraisal, notary, etc., that have to be paid by someone. When a lender offers no cost loan, they are increasing the interest rate to generate a rebate to pay those costs. Raising the interest rate 0.25% typically generates a rebate of about 1% of the loan amount. This is not inherently a bad deal, but you should keep in mind that you will be paying the higher rate for as long as you have the loan. If you thinking you will have if you think you will have it for at least a couple of years, you will save much more money by financing the closing costs into your loan and getting the lower rate. On the other hand, if you think a move is in the future, you would want to keep the closing costs you pay to minimum since you might have not enough time to recover them and come out ahead. For a shorter term, looking at certain ARMs such as those that are fixed for 5 to 7 years before beginning to adjust can save money since they start out at a lower rate. So I think you are able to understand that when you should refinance for a mortgage. So you are clear, then you can like the video and subscribe to the YouTube channel.